Managerial accounting, cost behavior. In the last chapter, we talked an overview about management accounting, what it is, what it does, the types of things that managers perform, the functions that they perform, what they need, and how they need it. We also talked about the differences, quite distinctive differences between financial accounting and managerial, and we touched a little bit on ethics and the type of jobs that are in managerial accounting. Today we're going to really get into the meat and potatoes of managerial accounting, cost behavior. What are costs? How we categorize them? How do they handle? How do they move? What do they do? What happens when we do this, that, or the other? How costs behave. In this chapter, we're going to talk about the various types of cost patterns. We're going to be using some different type of behavior analysis called high-low, scatterplot, count analysis. We basically, and I apologize for this typo here, I'll fix that later, but basically we want to just understand how to analyze the movement of costs. Why do we care about that? We're going to talk about that as well. We're going to talk about variable costing. What is variable costing? And we're going to be talking about a contribution margin statement and how it's different than a standard income statement. We're going to talk about costing methods, how to estimate costing methods. How do we estimate cost? How do we track costs? And then when costs move in a certain way, what type of things can we use? Can we understand and how we can predict costs? So the key characteristics of costs and its behavior. Cost is going to change when volume changes. That's going to be very, very important to understand. How costs change when volume changes. Well, if it's a variable cost, as you know, the more that you produce, the more it's going to cost. What about fixed costs? Those costs don't change at all. Actually, they stay the same. Depreciation is always going to be a good example because depreciation is going to be fixed regardless of how much you produce. Also, we're going to talk about mixed costs, which is going to be a combination, which is going to be extremely interesting when you're trying to calculate costs. So mixed costs are going to have a combination of variable and fixed. And how do you calculate the variable portion of a mixed cost equation? We're going to talk about that as well. So variable cost changes are incurred with every unit of volume. Variable costs change in direct proportion. So, and that's important as well. Graphs are also going to bring in an origin, but let's talk about all of this in a graph. Let's look at it in graph because graphs always seem to make much more sense. If you look at this graph here, you'll see in the table A, toiletry cost is $3 per guest. And as you can see, the volume of guests, the number of guests is going to be, and then the cost, and see how that cost goes up. And if you can see how as you have more guests, you'll have more costs. And the cost is going to be going up in proportion. As my number of guests are going to be increasing, the cost to the toiletries that they are using will be going up as well. So it's very important that for certain organizations, that's a critical component, because if you say you have less guests in your hotel, you have to see that your costs, your variable costs, are going to go down as well. And that's one of the things that we want to make certain we have the logic. Variable costs are going to change in direct proportion of the production. So in this case, the more people here that's going to be in your organization going to your hotels, the more it's going to cost. The less people who are going to your hotels, the less it's going to cost. And this applies only to variable costs. So using cost equation to express and predict costs. Let's talk about costs, variable costs and fixed costs for a moment before we get into this expression. We are a management accounting firm, and we want to be able to determine how can we predict costs and control costs. And so what happens in this scenario is costs are a driver in how much we can produce and how the profit is going to be derived, and whether or not we can continue, or whether or not we're going to break even, or whether or not we can have a profit, a profit motive, how much we want to produce to achieve a certain profit margin. So we have to have an understanding of our costs and how it moves. how it goes up and down, and what type of things will cause it to go up and down, and how we can control those costs. Because again, if we can keep our costs under control, we can have a higher profit margin, we can have a better profitability overall for the organization. So it becomes quite important. And this information is not going to be seen on the financial statements. It's only going to show the end product. At the end of the day, we earn this much revenue. At the end of the day, it costs us this much. At the end of the day, our non-operating expenses are these. With managerial accounting, we're digging a little bit deeper. We're understanding and analyzing a little bit more information because we want to be able to understand how our costs move so that we can predict how much it would take for us to break even, how much it would take for us to have a target profit margin, or what would our contribution margin, what would our bottom line look like if we had some scenarios. This allows us to do that. So using that information in mind, this is really a basic algebraic expression. Y is equal to Vx, and Y is going to be your variable cost, your total variable cost. Your V is going to be your variable cost per unit of activity, and X is going to be your activity. And again, I would just take a piece of this particular PowerPoint and just print it off and take a look at that and use it as a guide, because this is going to be one of those formats that's going to be, we're going to be talking about it for quite a bit. So kind of get used to it, practice with that. But what we're trying to do is we're trying to predict costs, and sometimes it requires us to first understand what the total costs are, so that we know how to calculate our total cost, which includes variable and fixed. Then we can have a better idea of how we can control those costs. Why would we want to control costs? Because these costs are going to affect our profit at the end. So total cost. Now, variable costs are going to be the costs that go up in proportion to changes in volume. We know this, right? So if we take our variable cost per unit and the number of units that we're producing, multiply them together, that will give us our Y. In this case, our total variable cost. Now, fixed cost. Again, we got our costs. Cost is going to be inclusive of fixed cost plus variable cost equals our total cost overall. But these costs don't change. They remain absolutely the same. They have nothing at all to do. They don't not fluctuate at all with production, but they are still relevant costs. They're costs that a company must consider when they are trying to determine how much it costs them overall to produce a product for a client. So they are important. They just don't change. And there are examples that are noted on the screen. Salaries are generally going to be someone's getting their pay and it's not going to change, no overtime involved. Lease or rentals, again, a rental for 12 months is going to be the exact same thing. Doesn't change depending on how many units we produce. The rent for that facility is the rent for that facility, for example. So understand what that is. So we got our fixed costs, and this is just a good idea of what fixed costs look like if you graphed it. $100,000 for our fixed costs going to stay exactly the same, regardless of unit of activity that we have produced during that period. Doesn't matter. It's going to be $100,000 no matter what. And that's the most important thing to get. So when we talk about our cost equation for fixed costs, Y is equal to F. Y is our total fixed cost. F is equal to our fixed costs, or our fixed amount over a period of time. Again, these equations are not very hard because they really make sense. We want to know what our fixed costs are. Our fixed cost is going to be the total amount of cost for the period. There's nothing else to add to it. Y is going to be equal to F, because our fixed costs are an essential straight line. Now, so as we mentioned before, just giving you an idea, just giving you some of the types of things that you'll be looking for when you're going through and practicing problems. Our total cost is going to be, doesn't matter how many units we produce. If our volume is going to be doubled, our fixed cost is going to be the same. However, the only thing that we have to note is with our fixed cost per unit, it does change. So fixed cost per unit of activity will be inversely in proportion to the changes in volume, and make certain you understand that. So know the relationships. Fixed costs going to stay the same, but fixed cost per unit is going to change because depending on the number of volume that you produce, it may go down as you produce more. It may go up as you produce less. So, and as I said, it's inversely related. So mixed costs, as we mentioned before, is going to have a component of both fixed and variable. And then we got, this is an example. In the hotel industry, you have fixed costs, which is going to be your common areas, possibly your rent or whatever. And then you have your utilities is going to be $8 per guest. And again, depending on how many people are going to be in your hotel, certain costs are going to be directly associated with that. Toiletries, utilities, and so forth. So mixed costs is going to have a combination of fixed and variable costs, and that's most important. And here is a graph of what mixed costs would look like. And again, no one's asking you to understand how to graph it. Just know how to read what the graph is trying to communicate. And it's just giving you this relationship between a fixed cost versus a variable cost, and then one with a mixed cost equation, how it looks graphically. And it's important to know when you have mixed costs, you know that it's a combination of that fixed cost includes, a combination of the mixed cost includes fixed and variable. So the cost equation for your mixed cost is going to be total mixed costs equal to your variable costs plus your fixed costs. And the X is going to be the number of units. So remember that. So those are, I think we've got 4 equations. We got our fixed cost equation. We got our variable cost equation, right? And then we have our mixed cost equation. So we have 3. Sorry about that. We have 3 equations, and they're not very difficult, but remember them and apply them in your problems as examples to help you reinforce your knowledge of this chapter. So again, variable costs and fixed costs make up your mixed costs. It's essentially what it is. So the relevant range, the band of volume where the following remains constant: the total fixed cost per unit, or the total fixed cost and your variable cost per unit. That's your relevant range. And again, this is all concepts right now. It doesn't make much sense until we apply it to a problem. Why would we be concerned with the relevant range? And you think about that as you go through the chapter. Why is it important to understand what the relevant range is? Why is it important to be able to distinguish among variable costs and fixed costs? When you have total costs, you look at total costs. Why is it important for you to know what portion of that cost is fixed and what portion of that cost is variable? Why is it important? That's what I think you'll need to be able to understand, so that when you get through the chapters, you can really help make decisions that are practical and useful. Some costs are not fixed in total. Some costs are step costs. They are fixed for a small range of activity, and then they jump up to a new level of activity. And know those kind of costs and how they look on a graph. So some are curvilinear. They don't fit any pattern. They go up in certain kind of a weighty kind of proportion, and never so much is neat or as predictable as the other 2 options we had before. But understand them and how to see them on a graph. So as we get through the chapter, what you'll need to understand is, what is a fixed cost? How do I identify it? What is a variable cost? How is it defined? When should I consider, or when do I know if a cost has both fixed and variable? How do I calculate the fixed cost from the total cost? To also understand and utilize the equations, the fixed cost equation, the variable cost equation, as well as the mixed cost equation. So that leads us to option number 3. How do we use analysis in scatter plots? Again, how do we analyze costs? Classifying them in your financial statements can be helpful. And a lot of organizations that are very simple in terms of that can use it. They analyze their costs. They go through the detail of their general ledger, and they identify costs that go up and down and fluctuate, and remove those to the costs that remain exactly the same. That's account analysis. But also you can use scatter plots. And then what a scatter plot tells you is really, the design of it is really to show relationships, to show if there's a relationship at all, and it's also to show if there's a strong relationship. So we can look at a scatter plot, and I'm going to give you an example. If there is a straight line placed all the way through, I wonder if you can see this, but if there's a straight line going all the way through, how closely would these numbers or these dots fit to that line? That's a good way. And again, it's all about being able to understand relationships if these items are related to one another. We want to see if they're related to one another. We want to see how strong the relationship is. And the scatter plot is an eyeball way to do that. A much more accurate way would be a high-low method to do that, analyzing cost behavior. Again, if we use the same information from the previous slide and we put a straight line through it, we can see how these lines or these dots are closely tied to the straight line. And that shows you a really good way to eyeball the relationship and the strength of that relationship. See? So for the high-low method, what we're doing basically is trying to find the slope of a line. And we want to find out what the high level of activity versus the high level of cost, the rise versus the run. And again, this is a very, very basic algebraic calculation, and it's not that difficult to do. All you want to do is take the net change, which is going to be your change in cost, and you're going to divide that by your changes in volume. So the high amount, subtracting the low amount, dividing it by the same number, the high amount in the volume and the low amount in the volume. Essentially, we want to find out what is that change. So here we have an example. We want to find the vertical intercept. So first of all, we want to take the y is equal to vx plus f. The y is total cost, okay? V is going to be the variable cost. X is going to be the number of units. And f, as you know, is the fixed cost. So if we're going to use the high or low method, we want to make certain what we're trying to do is find out what is, in this case, find the vertical intercept, the place where the line intersects with the eye, or the fixed component. So we're basically trying to determine what is our fixed cost. In this particular transaction, we know y is equal to 209,600, but of that 209,000, how much of it is fixed? How much of it is variable? And that will allow us to do that. And again, this is not necessarily the hardest of calculations. It's actually the most simple. Many students have problems with the actually understanding the scatter plot versus you doing the high-low method. So the high-low method is pretty straightforward. I suggest highly that you just keep your calculation in front of you and just practice. And then the question then becomes is, what are we trying to determine? Why are we trying to do it? What makes this particular process different from the scatter plot? What's the advantages of it? What's the disadvantages of it? Obviously, you're only looking at 2 points in time, so it's not giving you a lot of information. So it's more accurate, I think, than a scatter plot, or may it very well confirm a scatter plot, but it does just show you 2 points. So it's very important to notice that all of these have their own advantages and are useful given what management is trying to find. Regression analysis is the far more complex, but also the far more accurate way to analyze cost behavior. And we're using a regression analysis. And again, regression analysis should be done with Excel. Never, ever try to do it on your own. It's very, very complicated. And in fact, a graphing calculator or Microsoft Excel is the way it's done, period. And so, and I will try to do a regression analysis example to give you an idea. But what you're trying to see is, how can we determine what our X variable is? And again, I'm going to go back to the previous slide to show you. This is what we're looking for. In the regression, we're calculating using regression analysis to get this number as well as this number. So we'll go back. So we're trying to find the X. The R squared, again, this is going to tell us how related these transactions are. We want to find the coefficient, which is the x-intercept. And again, using this data gives you a lot of information. It tells you how strong the relationship is between the two. It tells you again, this is just giving it to you graphically. It tells you how strong the relationship is. It also gives you an idea of the correct, the more statistically accurate slope. Whereas we were using the high-low method, only selecting 2 points, it does give you a good idea, but this is highly accurate. And organizations do prefer a regression simply because they want to have very, very specific information, very, very accurate. So Now, as far as the relevant range is concerned and inflation and other outliers, those are kind of things that you'll have to be concerned with. But for the purpose of this section, I think understanding what a regression analysis does, the information that you can extract from that, and how it differs from a high-low method and statistical or a scatter plot, or in this case, how we use account analysis to analyze cost behavior. So there are 4 different ways to do it. Some are much more intuitive, some are a little bit less accurate or less reliable, and some are highly accurate and a little bit more complex. So describing variable costing and preparing a contribution margin, relevant costs. Again, what you want to make certain when we're talking about variable costing is we want to think about costs as product costs. We want to use these information to be able to analyze the movement of those costs. How can we treat these costs? How can we monitor these costs? How can we control these costs? And how are we using these costs to prepare our variable costing? Because absorption costing is really going to be financial statements, which are going to be including all of costs in that equation. But for variable costing, we're not using all of costs. We're going to use for certain ones, which is why you need to understand how financial accounting is very different from managerial accounting. Managerial accounting, we care about variable costing, and we're not going to be including all costs. We're going to be including only selected costs. But more absorption costing is going to be using all of those costs. And that's another major distinction between the two. And again, absorption costing is GAAP, variable is non-GAAP. And look at the differences. I'm showing you here how they are different, how important it is to see that internally we're much more concerned about very specific type of information, and how some information may not necessarily be relevant or appropriate in GAAP, but very appropriate in variable costing. And now look at from the financial accounting perspective, absorption costing, how a traditional financial statement would look like, income statement, for example, and how it differs from a contribution margin, assuming variable costing. Look at the difference before and after. Now, again, as I mentioned before, organizations are concerned with very specific type of information, most of which is either hidden within the financial statements and not clearly seen, or not accounted for at all. So managerial accounting is going to be digging into the weeds and getting much more different and much more relevant day-to-day information than one would be given for external users in a financial reporting context. So we are looking for much more detailed information. We're looking for information for operational purposes, how much to produce, why to produce, what's our contribution margin per unit, how much units do we need to produce on a given cycle, how much, what's our break even on a given cycle or a different product line. Should we continue? Should we not? All of these kinds of questions are not necessarily easy to answer if you're using GAAP financial reporting, but is absolutely easy to create and to determine when using managerial accounting, more detailed information to get that. And again, we're just giving you some visuals. I would say in this chapter, one of the things that what you all need to understand is the role of variable costing, the role of how to determine what your variable costs are, how to calculate your total cost and extract your fixed cost portion of that using the high-low method, the regression analysis, as well as the scatter plots to understand relationships and how costs behave and how they look. In this chapter has a lot of information, but be very clear, we're not trying to dig so much into it, but we do want you to understand exactly what these costing, how important variable costing is, and the type of tools organizations can use to understand how costs behave. As we finish up this chapter, I think the most important thing I wanted to bring to your attention is understanding variable costing and how it affects the income statement. And real quick, these are just some points that I think are kind of important. One, variable costing, it treats all manufacturing overhead as operating expense and period incurred. So what you have to consider, manufacturing overhead, what is that? Why is it considered as an operating expense? What does that mean? And it's only used for internal management purposes, never ever for external purposes or tax. Also, variable costing is often better for decision making for absorption, but it also shows managers how additional costs of making one more item or product can vary per unit. So knowing your cost per unit is kind of important. Also, it does allow you to evaluate performance better. Absorption costing does not give you that type of information. In fact, it's actually more important for managers in terms of incentives to use variable costing because it's a much more accurate way of understanding how their costs and how their cost moves and shifts, and also how products are costed and how profit is derived. But also, operating income is going to be very different when you're talking market absorption costing on the variable costing. So understand that. In the end, cost behavior is very important because you're going to be considering variable costs. You're going to be taking your variable cost, subtracting it from its sales revenue to get your contribution margin. Remember, look at your contribution margin, analyze that. Be very, very clear on what information is presented and how it is different from standard financial statements. Also, traditional income statements does not necessarily provide the most helpful information for planning and decision making because we want to have much more detail. We want to be able to see costs and we want to be able to identify what those costs are. And some information is just not necessarily useful in that. And finally, it also shows the traditional and operating income can very well be the same if you're talking about a service firm or a merchandising company. Merchandising companies and service firms may very well see similar, almost the same in terms of their operating income. However, manufacturing is going to be very, very different. So thank you very much for this chapter. I hope the chapter 2 provides a lot of clarity, and also this video. This video is just definitely designed to help you identify various concepts that I think are very important for you to remember and to review as you continue on to the next section of the module. Thank you.